Hello, this is going to be a video on Kohl's, ticker symbol KSS. I believe that it's a very undervalued business, and we'll get into the reasons on that shortly. Mostly starting with some misconceptions that I believe that most people do not understand regarding the business and their real estate, what their real estate portfolio is worth, how much the minimum that somebody would be interested in buying the business at, which I would say is probably the floor on where the value is, and some different ways to value the business as assets versus liabilities, and also on income, because they are totally different. So we'll get into it. The first major misconception that I believe is on the depreciation. Basically, so Kohl's owns a lot of real estate, and the depreciation, say they buy a building for $10 million or something like that, and say $2 million of it is in land. You can't depreciate that, but that $8 million that's left over, they get to depreciate that under a standard schedule of 39 and a half years under the IRS standards for that. And that is not a real expense. Anybody that understands real estate knows, as this says right here, that real estate is different than equipment, that properties seldom lose value and it often appreciates. I would say that commercial property in this scenario, it appreciates slowly over time. Maybe like 1 or 2% a year would be pretty standard for the type of real estate that they have. So it's not going to be like a high flyer like homes have been at certain times, but it doesn't normally lose value. And under that same example, if they bought something 40 years ago, 39 and a half years ago, you get down to the end of that, and that $10 million building is worth who knows what, and it's on their books for the $2 million of land that they purchased it for. That whole time, their earnings get underreported just because it's basically a tax loophole that the IRS allows for property investors. And we'll get into shortly on how much that their income gets underreported every year. And that's the standard analyst, I would say. They just go off of a certain multiple on what their reported earnings are under generally accepted accounting principles, but that's definitely not the actual earnings that they make. And then the second one is that the leases, a standard thing you see on, if you look at certain places online like Reddit or other places, a lot of people say, oh, Kohl's has a lot of debt. Well, we'll get into that too, but the leases are actually not debt. I'll break it down to what I believe the leases are. This over here to the right is the standards for how that they report leases, and actually 74% roughly of their leases are in options to renew a lease. And under this, they are only supposed to include that if they're reasonably certain to renew the lease. So for them to be reasonably certain that they're going to renew a lease, it must be beneficial to them. Otherwise, they wouldn't be reasonably certain of it. But we'll also get into that a little bit further. And as far as down here, basically, after you add in the depreciation, current multiples, it's trading for about 3 times earnings if you know how to calculate them, which I will get into. It's trading at a massive discount to intrinsic value and to the tangible value. A very big part of that is because there's a very high short interest. There's a lot of short selling on it currently, and that's holding the price down, but eventually things do to return to their real value, I would say. Maybe not in the next week or month, but over a period of a year, 2 years, something like that, it'll find its way to the real value. On the next tab here, I have things that I've taken out of certain reports. This first one is out of the last annual report that shows all the properties that they have. As you see, very few of them are in malls. 62 stores are in malls. The rest of them are either freestanding or in strip centers, which basically anybody knows that malls are dead or dying for the most part. That they are in good locations. They're all over the place. They own 406 of the stores. They lease 521 of them in ground lease, which means that they own the building but have a long term lease on the land of 247 of the stores. In addition to that, over here is all the distribution centers and e-commerce fulfillment centers that they have. There's one of these, the San Bernardino e-commerce fulfillment center. The lease is coming up in a couple months, and they're closing it. But oddly enough, as you would expect for a company that's trying to improve their profits, they lease that one and they own the rest of these. And the announcement said that they have the capacity, due to increased efficiencies and technology, that they actually don't need this. So it's actually going to be, I estimate that the rent on this San Bernardino facility is probably about $10 million a year. That's just going to go straight to profit going forward. They own this, and this right here. And then there's only 2 other distribution centers that they lease too. So that's a lot of real estate that they own. And some of these, such as I look at this Ohio e-commerce fulfillment center, it's very, the county assessment is $85.7 million, which is probably low, but it's just giant, 57 acres almost, just huge, almost brand new, 1.3 million square feet. They have a very, very, very valuable real estate portfolio. And my question would be, so if you add up the current market cap, which is a little bit less than 1.5 billion, and we'll get into it a little bit further on as far as how much actual debt they have. What they do every fall, rather than sitting on a pile of cash all year long, is they borrow a little bit on their credit revolver when they load up for the fall and holiday shopping season. And so it looks like they have a little bit more debt on this last report, the quarterly that came out, but I estimate that after they report their earnings here in a couple months, that they're going to have about 1.5 billion in debt. So you add the market cap and the debt, you're a little bit under 3 billion. Say round it to 3 billion. $3 billion for all of this, so you could figure out how much value is in these distribution centers, e-fulfillment centers, warehouses, whatever you want to call them, the ones that they own, the 406 stores that they own, the 247 ground lease stores. At $3 billion, you can run your own numbers on it, but I feel like that's basically the real estate investment of a lifetime personally, but you have to come up with your own conclusion on that if it looks good to you. Look at what some stores are going for. They have some stores that investors own that are for sale currently, and I feel like it's a really good deal personally. Kohl's has been a buyout target previously. The current CEO that's been there for about 2 years is not, well, I guess at the day that I'm recording it, January 15th, he is not the CEO anymore. He's just transitioning out of it. But he wasn't open to a sale, but the new CEO will be. Back in 2022, they received multiple buyout offers. There were a lot more shares outstanding. They bought back shares since then, but it would have been the equivalent to over $70 a share in current numbers. And they decided to walk away from that. It was the COVID. Credit markets were starting to tighten up, and interest rates were starting to go up and everything, and they just decided that they didn't want to deal with it. But right now, that there's, with the prices currently, I mean, Kohl's is definitely a buyout target, especially under the new CEO, and we'll see what offers come and at how many people are interested and at what price, that'll be determined here shortly. But at the same token, Kohl's doesn't actually need to be bought out. The new CEO can realize that he has a background in finance. He's sold the last company, Michaels, that he was the CEO of. He sold them to Apollo, a private equity firm, for a massive premium. And I think my personal opinion is that that'll happen again. But he could just run with it and buy back a lot of the undervalued shares and unlock a lot of shareholder value here currently. One way that you could think about it personally is if the real estate portfolio is valued at $8 billion, which I think is the low end of the values, a buyer could take it private. They could get secured financing for about 60% of the loan to value. If they offered a roughly $30 a share, they could buy it, get all their money back immediately with a secured financing deal and have no capital in it and still have a profitable business. I mean, that's really basically the holy grail of any kind of real estate investor, to get all your money back right away, still be making money, and at what I would consider somewhat the rougher high end of the valuation at $10 billion real estate value, they could do the same thing at about a $40 a share valuation. And that I would say is the floor of where the value is here, the $30 a share number. Because if somebody can buy the company with the real estate and have no money in the deal and still have a profitable business and everything, I mean, that's a no-brainer for me, even at $30 a share. Right now, it's a little bit under $13 a share, so it's about like 2.5x from here. That's a long ways to go for the low end of the shareholder value, in my opinion. The next thing here is the real enterprise value. I did some rough estimation here. As we talked about before, market cap is a little under 1.5 billion currently. I estimate that they'll have about 1.5 billion in debt coming out of the holiday season. So total cost to buy the business would be about $3 billion. And as I said before, the valuation on the real estate somewhere between 8 and 10 billion approximately is what most people think. I agree with that. And there's also a profitable business in there. And here, this is from the last annual report. Shows the property and equipment, everything. This is how much that they paid for land, buildings that they owned, improvements in buildings that they lease, fixtures, equipment, information technology, construction and process, all that. So you get to this total, and then this is all the depreciation that they took. And if you look at this, this is in millions, so it's 7.2 billion. This number is bigger than this, all added together. So they have more depreciation than even what they paid for buildings that they own and land. And that's all included in over here. This is the balance sheet from the last quarterly report that they put out. And that shows that there is $34. This 3.8 billion works out to be $34.17 a share, I believe it is, of shareholder equity. But that includes a lot of things on here, and we'll get into that in the next slide. But one thing, as we talked about before, the leases. This snippet is from the last annual report as well, and it shows this is operating leases. I've come to conclude that operating leases is for all the stores that they have a full lease on. Finance leases, at least a vast majority of it, I would say 95% plus, is for stores that they have a ground lease on, and that is legal under GAAP rules, but they kind of differentiate between the two of them here. So this is what they have coming due on each year. This $5.2 billion of operating leases and $4.3 billion of finance leases in total. But you go down to here and it says total, I highlighted this just to give a little bit better clarity to it, but the total lease payments include $3.9 billion in options to extend operating lease terms that they're reasonably certain of being exercised, and $3.2 billion of options to extend finance lease terms that they're reasonably certain of being exercised. And so, I mean, that's where I came up with the 74% of the leases are just in options, and how the accounting on it works is below here, amount representing interest, they take this number and they discount it back to present value, and that's the number that gets recorded as the lease liability. And then they determine how much, they record something on the asset side. For the operating leases, they get reported up here, and it's the same thing. They come up with how much value they think they're going to get out of it in the future, basically, and then they discount it to present value. And then on the finance lease side, they put it in a line under the property and equipment net and discount it back. But this number isn't even remotely accurate that you could call it debt. Most of it is, it all comes out of the normal expenses and they are profitable and will continue to be profitable in my opinion. It's a rent expense. They're either renting the store or they're renting the land that they own a building under. And there might be a few $1 million worth of some kind of equipment that's in this finance lease, but it's very minimal, and it's definitely not debt. As far as tangible book value, this is the same balance sheet that was on the last slide here, but the $34.18 a share is it. As I said before, you take this shareholders' equity divided by the amount of shares that are outstanding, and that's how you get to this. If this number's the IRR's internal rate of return factors in the time value of the money, and this was actually, I came up with the numbers a couple days ago when the stock price was even higher, so the rate of returns would actually be higher than what's on here. But at 1 year of holding with the current dividend level, this 168.2% rate of return is what you'd be looking at. 3 years be 47.7, and 5 years 31.4. I feel like, as I said before, all the depreciation that's in this number, as you see, rounded to 7.5 billion. If the real estate on the low end is worth $8 billion, this number is low. But even saying that this is the low target, I mean, even if it took 5 years to get there, 31.4% is a good return. 3 years, I mean, I can't imagine that this thing gets held down for 3 years. Making an almost 50% rate of return is a very good opportunity, in my opinion. And then there's two different ways that I looked at the income portion. This is off of 2023 earnings. So they had net income of $317 million. That's after taxes. Estimated depreciation from owned buildings, $212.1 million. And I got that number. We'll just track back here. Take this owned number, 8.377 billion, divide that by 39.5, and that's how you get the yearly amount of estimated depreciation. It might be a little bit different, but I'm just taking an estimate on what I think. And you add those two numbers together, that's you get 529.1 million of what I consider to be real earnings, 4.75 cents per share. And right now, that's actually trading at less than 3 times earnings. And typically I would say most people would value things at 8 or 10 times earnings. In this situation, 8 times earnings would be $38 a share, and then here's the IRRs at the 1, 3, and 5 year mark. 10 times would be $47.50 in these IRRs. And one thing to keep in mind, that are actually currently investing a lot of money into growth, capital expenditures. They're putting in Sephora's in a lot of stores, doing the Babies R Us store concept, and they're refreshing a lot of the stores that are doing well. And a lot of people, when they're doing their valuations, they also add back the income tax, which they pay to $56 million a year. So I feel like these are actually both pretty conservative numbers, and that they are way, way higher than what it's currently trading at. Another way, which is a little bit more of a most people would not come up with the earnings this way, but I looked at it from a more of an asset based, from the trailing 12 months, I would call it. This is the last quarterly report, and I looked at shareholder equity compared to a year ago. It increased 53 million, this number to this number. It increased $53 million. I consider that an increase that's retained earnings. What that number would have increased by if this property and equipment had not been depreciated from the earnings, if they didn't depreciate the buildings that they own, this number would be $212.1 million higher. So their retained earnings were actually these two numbers combined up. If they didn't take the depreciation expense, it's not real. And then they also paid out dividends to shareholders, which would be a non-retained earnings. You add all three of these together and you get $487.7 million in real earnings, which is pretty similar to the 2023 number, $4.38 a share. And it's also, that's about 3 times earnings. That 3 times earnings and significantly under what the assets are worth after you take out the debt. That's just not something that, it's not going to last. That's, in my opinion. Do your own research. This isn't investment advice for you. I think that the best thing you can do is take this information and do your own research. Verify that what I said is true, and come up with your own conclusion on what you think this is worth. And that's, but this 8 times target, IRRs over here, 10 times target, same thing. It doesn't add back the growth capex that they put in or the income tax that they paid. Those numbers would be higher. And, lastly, there's a lot of fear and uncertainty that people are throwing out there right now with, they just put out that they're closing 2% of their stores that are their worst performers. Over 90% of their stores are profitable. And a lot of those, if you look into them, like there's one in California that, there's the last one operating in the mall basically, and a school bought the whole land because they're going to build a school on there. Well, they're at the end of their lease. Why would they want to operate there? Just let the school be built. And they're probably going to be closing down, consolidating a little bit on closing down stores as the leases are up, and leaning more on their real estate portfolio, which actually is what I would consider a moat, as Warren Buffett describes it. A lot of these, they're more expensive stores that their rents are like $1 million a year. If you own the real estate, you don't have to pay that. So they're competing with another store that has to pay that. That money is just going straight into their profit, basically. That, it's hard to say exactly how long it's going to take for them to turn around. But they're making decisions that their profit's actually going to be higher going forward. Their revenue might be slightly down, and I mean slightly. I could say in my situation, within 15 to maybe 20 minutes of leaving my house, I could be at 4 different Kohl stores. And, if the lease was up on one of them and they decided to close it because it was the worst performer, I'd drive an extra 5 minutes to go to one if I decided that's where I wanted to go shopping for the day. So they have a really big network of stores that if they end up closing, a few more, even like 50 or 100 of them over the next 5 years or something like that, if that's the ones that have really high rent or don't have the best, if they close out the worst ones, they're actually going to be in a stronger position going forward. And I'm curious to hear people's comments on this. I think especially with the short interest that when you look at it, there's 40 some million shares on the last update that I saw that's future buyers. The company starts buying back shares. People see that this is really undervalued and start buying it. I think there's a pretty good chance that it gets rocking and rolling quickly, but we'll see. Anyways, leave a comment below. I'd be curious to see everyone's opinion on it.